Hi everyone, welcome back to the video friends. In today's video, I will provide you with three setups, obviously which will be based on 200 moving average, and one of them will be for trend following and two for trend reversal. So if you want to do trend following or trend reversal, the 200 moving average is equally important for both. So let's see which are those three setups and how you have to trade them. So first setup is based on trend continuation. And if you trade on trend continuation, then basically the 200 moving average will work as a support. How does support work? If a price falls on any spot and a sudden bounce comes from there. So what do we call this? This is a support that has been bought here. Now when the price will come on the same level for the second time, then we are ready to buy here because chances are high that a support will come here and a bounce will come from here. Now the same thing works in the case of moving average. Whenever the price falls on the moving average, let's say on the moving average of 200, there is a high probability that the price will bounce up again. It's simple. How does support and resistance work? If there is a level that everyone has drawn in their chart, let's say here is a level of 1,000 and the price has already bounced 2 to 3 times. So everyone can see that a bounce comes from here. Whenever the price will come on the level of 1,000 again, everyone starts buying here and a bounce comes. It's simple. The same thing happens in the case of moving average. If you plot the moving average of 200 on your chart, or I plot it on my chart, then the moving average of 200 will come in the same place in both the charts. So you will buy here and I will buy here. When there is a mass buying here, there is a momentum on the top side, and that we call a trend continuation or a bounce. So whenever the price will come on the moving average of 200, there will be a W pattern here, or we will identify a reversal on a small time frame and try to take a trade with a small stop loss on the top side. This is your trend continuation case. The second case is of trend reversal. The second case is trend reversal. There will be some cases for trend reversal. Watch them carefully. First of all, the moving average of 200 will be declining. If the moving average of 200 is declining, then you have to trade for trend reversal. Let's talk about how to do it. Now, if the moving average is 200 declining, then we can assume that the price is trading below the moving average, and that is completely fine. Whenever the price is trading below the moving average will act as a resistance and the price will try to come down. So how will we identify when the trend reversal will happen? Watch carefully. If the price goes near the moving average and continues on the top side, then we don't have to trade. In 90% of the cases, you will see a reversal because you can't identify the moving average exactly on the spot and take a trade. The moving average can go up or down and bounce. So there are three cases. It can bounce on the dot, it can go up and come down, or it can reverse before the moving average. So what you have to do for this is to wait for the retest. If the price goes up again and touches the moving average or comes around it and crosses this level, which was the recent high, this is your entry position. Where should your stop loss be? Obviously, it should be below the moving average. So this is the second case, and the third case is the same trend reversal. Let's say that the moving average is here, and you want to trade for reversal. In this case, you need a retest. If the price waits below the moving average for a few days, consolidates below it, and crosses it again, then you don't need a retest. You can immediately create an entry here. In this case, your stop loss will be below the consolidation phase. In the first case, we were working like a support. If the moving average is inclining and the price bounces on it, then we see a reversal pattern and trade continuously. In the second case, the moving average should be declining and the price should be below the moving average. If the price is also below the moving average and the moving average is declining, then we wait for the price to cross. After the retest, it will cross its high again, and we trade here. In the third case, if the price waits below the moving average for a few days and consolidates, then it crosses the moving average. Then we don't need to wait for the retest, we can directly trade here. Let's move ahead. I have told you 3 cases. Let's see some examples. This is the weekly time frame chart of the Federal Bank. We will check all the time frames one by one. Here is the moving average of 200. The price bounces every time from the moving average of 200. Our second condition was that the moving average should be inclining. If the moving average is inclining and any price falls on it, then chances are high that it will bounce on the upper side. One thing to remember is switch to the daily time frame. If you see here, this is the daily chart of the same Federal Bank, and this is the moving average of 200. Whenever the price comes near the moving average of 200, it gets a bounce. Again, it comes near the moving average of 200, it gets a bounce on the upper side. Again, it comes near the moving average of 200, it gets a bounce. Now, if you see here, it has broken, but this is a fake breakout. What did I tell you? If the price comes near the moving average of 200, it gets a bounce on the upper side. If it comes near the moving average of 200, it gets a bounce. If it crosses this low, then you can confirm that it has already broken. So obviously, it didn't happen here. And the price immediately went up like a green candle. Same condition here, same thing here. The price went up, but it didn't break this low, and again it got a momentum on the upper side. So whenever you wait for a retest, you will avoid fake breakouts. Let's switch to the early time frame. And if you see here, this is the same moving average of 200. See how beautifully it works on every time frame. The price comes near the moving average of 200. The moving average is inclining. It gets a bounce. Again, the price comes near the moving average of 200, and the moving average is inclining. Again, it gets a bounce. The price comes down and it breaks, but it should have gone up and broken if it had to come down. But what happens here? There is a W pattern here, and the price goes up again, right? With a little practice, you can tackle the fake breakouts of the moving average easily. In 90% cases, if it comes down after the retest, then it is a real breakout. But many times, due to fake breakouts, it comes down, but it goes up again. So this is the example of trend continuation. Let's see some examples in which you have to identify the trend reversal and how to trade. So this is the chart of NMDC daily time frame. If you see here, the price was breaking the moving average of 200 a few months ago. The price tried to go up, but the recent low broke it. So at this point, you have to confirm that there is a break. So here you get a trend reversal identification, and the price came down. Again, the price is trying to go up, but the moving average of 200. If the price is trying to cross the declining moving average, then it gets a resistance. Moving average is declining, which means the trend is down. In this case, if the price hits it from below, then it gets a selling, but still the price is trying to go up. If the price crosses the recent high, then you can confirm that the price has changed. So this is the trend reversal setup, that is breakout and retest on a moving average. What can be the second case of this? If the price was waiting for a few days below the moving average, then we can take the trade with confidence as soon as it breaks. So these were the 3 setups, which are based on moving average and EMA. I have told you one of them for trend following, which is for trend continuation. You can use that as a support. Whenever the price comes on an inclining moving average, you can use that for bounce. The other 2 cases are for declining moving average. If it retests or consolidates and breaks, then we plan for a reversal. I hope you have seen both the cases carefully. If you find it helpful, then you can comment below and like the video. That's it for today. See you in the next video. Till then, bye and thank you.